Hello, welcome back. We're looking here at question 2 on the specimen paper 2 for the strategic business reporting paper. And this is a good example of the new type of question that the examiner is bringing in here. So the new sort of focus of the exam. Remember that there's now more of a focus in strategic business reporting really on the investor perspective. So we're really thinking about potential manipulation of accounts, how to avoid that, and potential incentives for people within the business to manipulate the accounts and the effect from an ethical point of view of that. So just looking at this question, let's look at the requirement first. So it tells us to discuss the ethical and accounting implications, and we're doing it from the perspective of the accountant. So thinking about from their perspective. It's 13 marks with 2 marks for the application of the ethical principles, giving us 15 marks overall. So this is quite a bit more detailed than you would have got in the previous incarnation of this paper. So we're looking at a little bit more detail on ethics when it comes to this, but I do think that if you structure this in the right way and think about the right things, you can really pick up marks well on this. So you're always looking for incentives to potentially manipulate the accounts, and then you're really thinking about how they may have done it given the information that you've got here. So looking at this question, we've got Gusto. It's a public limited company and they produce a range of Italian foods and prepares their financial statements with IFRS. Now, here's something interesting. They receive a cash bonus each year if reported profits exceed a predetermined target. Now, that's always going to be a potential problem because what you've essentially got here is an incentive to manipulate the accounts. Because if you are going to get a bonus based on the profit, well then it's in your interests to make the profit as much as possible. So I immediately think, well, okay, there's definitely a potential here for pressure on management to manipulate the profit. So let's see what their profit is like. They've performed in excess of the targets. That's good for the year end X7. However, forecasts for 2008 are pessimistic. So they've gone above the targets in X7. They're worried about X8. So I'm now starting to think, well, okay, maybe are they going to maybe think about changing things in X8? You know, there is a potential there. So let's see what information we're given. Now I'll deal with these two separately. So I'll talk about provisions and then I'll make some notes as to what we would include in the answer. And then I'll look at this wheat contract. So looking at the provisions first. So we've got a new accountant here. They've noticed that provisions are significantly higher than previous years. Now that's in X7. So let's think what that means. It means that they've been doing entries that will have debited the P&L and credited provisions. So what that's really doing is it's reducing profit. So they were in excess of their profit target in X7 and they've been reducing it. Now why might they have done that? Let's look on and see. She made inquiries of the finance director who explained that there were substantial changes in food safety, etc. And as a result, they must retrain a large proportion of its workforce. The retraining has yet to occur, so a provision has been recognised for the estimated cost of 2 million. And that's going to be in X8. Now immediately I start to think that that's a problem because there's been changes in law. They do need to retrain their workforce, but that may not be an obligation. Now remember, to have a provision, you need to have an obligation, it needs to be resulting in a probable outflow, and you need to have a reliable measure. Now they've measured it, we've got the 2 million. and it's probable they're going to have to pay it in X8 because that's when it's happening. But the retraining is not an obligation. You could just not retrain them. There's no legal or constructive obligation to do so. So that is a problem. Let's think of it from an ethical point of view. Why might they be doing it? Well, if they recognise this 2 million of a cost in X8, it's going to make their profit go down even further. And they definitely won't hit their targets and get their cash bonus. So what they might be doing here is trying to push some of those expenses out of X8 and into X7 through creating a provision. So saying, well, we're going to have to pay this in X8. It's going to reduce our profit in X8. We're not going to get our bonus. Let's get it into X7. Now that's really a problem because it's an ethical issue. So you've got some ethical problems with that. Not to mention that it's the incorrect accounting treatment. So the finance director told them the inquiries were a waste of time. That's ethically questionable and would not be looked at favourably. So she's been put under pressure. And that's a problem from an ethical perspective as well for the business. So there's a few things we can talk about here, and we need to think about how we're going to pick up the marks. So we want to hit the ethical bit. So it says the ethical implications. We want to hit the accounting bit, so we pick up marks for that. And we want to do it all from the perspective of the accountant. So I'll make some notes here. Just writing around these notes would enable you to pick up the marks. These are the things I would suggest you'd need to include. So let's start from an ethical perspective. And this is just looking at the provisions. We'll look at the other part of the question in a second. So from an ethical point of view, I would start off by saying that the cash bonus is based on profit. And in fact, reported profit. At the minute, they have excess profit over their target in 2007. But forecast not to hit their target in 2008. Okay, and therefore, as we recognize, there is an incentive. The incentive is going to be to move expenses and move those expenses from 20x8 to 20x7 because they've already hit the targets in x7. They have a bit of leeway. They could reduce the profit a little bit and still hit their profit target and get their cash bonus. But in 20x8, they're not going to hit that target. So why not move some expenses from x8 to x7? Therefore, we may hit the bonus in both years. Big problem there. There's potential breach of integrity. There's a potential breach of objectivity because you're not producing accounts that are non-biased. Maybe if they didn't know what they were doing, you could talk about professional competence. But I think here this line about, well, it won't be looked at favourably if you investigate this, I think that implies that it's a bit more than that. I think that implies that they know what they're doing and it is a breach of these things. It's really from the point of view of the accountants involved. It's a self-interest threat if you wanted to think of it in that way. It is in their interests to manipulate these accounts because they will get more money as a result. So there needs to be some discussion of what has led to the potential ethical threat, what principles there's a problem with here and why. From the accounting point of view, you would need to discuss the treatment. So from an accounting perspective, well, for a provision requires three things. And if you don't have those three things, you shouldn't have a provision. You need to have an obligation. You need to have a probable outflow. And you need to have a reliable measure. So I would let the examiner know that you are aware of that. So you'll say, look, to have a provision, we need to have these three things. In this case, there is no obligation to retrain staff. Now, it's going to be a good thing for the business to do. It's going to enable them to trade in the future and not breach health and safety, but it is not an obligation. They don't have to do it. Therefore, there should be no provision. And therefore, they are understating the profit in X7 and potentially then overstating it in X8. And that's a problem. Also, I would mention the comments made by the finance director are unethical as well. To say that they will be looked at unfavourably, that I think is a problem, because it puts pressure on the new accountant. So I would say comments made by the finance director are unethical and put undue pressure on the new accountant. Okay, so those are the sorts of things we need to be hitting on this. We need to be discussing the ethics, and it's really important, and this is a good example question of it, it's really important that you are able to identify where the potential problem is in this, because it's not going to be immediately obvious. You will have to think about the accounting treatment and think to yourself, why would they be doing that? What is it that they're trying to achieve from it, or what effect will it have on the accounts, and how will that then potentially lead to an ethical threat for the accountant? So it's a very good example of how these questions will be put together in the future to try to see, can you understand the accounting treatment, and can you then understand the implications and the potential implications from an ethical point of view?